So this is item 71 on the checklist. It's the first one we're going to go over today, which is you want to check this box. Are you a Delaware C Corp? You need to be a Delaware C Corp if you're going to raise money from investors in America. Why? Well, Delaware law is very favorable to shareholders and to companies. This means the company must do what is best for all the shareholders in the company. And this is why venture capitalists and founders and everybody involved in entrepreneurship has really selected this as the winning type of corporation. There are other ones out there that might be better for crypto or might be better for hedge funds. There are offshore types. But for whatever reason, this type of company has become the standard here in America. And even if you're an Australian company or UK company, you can be a Delaware corporation so that people can invest in your company easily. Once you say you're a Canadian company, a European country, or a company in a specific European country, tax, lawsuits, investor rights, going public, tax treatment, I already mentioned, I think accounting practices, all of that and HR issues all will change. If you're investing and you're trying to scale an industry, you really want to be comfortable and understand one of these jurisdictions, and that one is the Delaware C Corp. Investors are very comfortable about it. They know it. The process is super straightforward, and there's very limited liability. There are some tax benefits. If you're an international company looking to raise some US VCs, but you don't have a US entity, well, you probably should just create a US entity. You can talk to your attorneys about that. Some people flip it over, but it is absolutely correct to do a Delaware C Corp. Now, some people say, hey, what about an LLC, one times tax treatment? The problem with that is if you're going to take investors and you start as an LLC, you're going to have to switch over to a C Corp. And when you do switch over to a C Corp, a Delaware C, it's going to just be like paying your legal bills over again, and you could have accounting issues. LLCs are great for venture funds or partnerships like a law partnership or an accounting partnership with a bunch of CPAs, or maybe you're buying real estate assets because it has one-time taxation, and that's great. But you don't have shares in an LLC. You have units, and it's a completely different structure. They're for two different types of entities. So you can talk to your lawyer about that. You can do some Google searches. But just for the purposes of this checklist, we don't really need to debate it. You need to be a Delaware C. And you, again, when you're raising for venture capitalists, you don't want to throw up red flags. Having the wrong incorporation is like walking into the room holding like 5 red flags in each hand that you don't know what you're doing. Okay. Item 72. Do you have a cap table, and is it clean? A messy cap table is a deal killer. It is a huge red flag for investors. And it often results in people not investing in a company. When they say the cap table is broken or a messy cap table, it means that there's some people early on in the cap table that have a very large percentage of the company, and maybe they got it at a very low price. And then the founder's ownership is way below 50% before they get to Series A. When you're at a Series A, you really want the founders to be above 50%. So you have 2 founders, 25% each. You have 3 founders, 15 to 18% each, maybe even 20% each. Why does it need to be there? Well, we anticipate there'll be a Series B and people will be diluted 15, 20%. There'll be a Series C, maybe you're diluted 10 to 15%. And then you do another round of funding and you're diluted another 10%. You get the idea. You get diluted a couple of times. You might be down, if you're a solo founder, at 20% by the time the company gets sold. Or if you're 2 founders, you might wind up with 7, 8, 9% of the company when it goes public. That seems fine. It seems fair. You have all this money put in. The employees got 10, 15%. A bunch of investors got the bulk of the company. They put a ton of money to work. And maybe you sold some secondary shares along the way. But it needs to be clean at the start. And so pre-Series A, founders going to need to own 50 to 65%. At Series A, maybe they get cut to 40, 50%, like I was saying. Series B, 30, 40. Series C, 20 to 30. IPO exit, 10 to 20% ownership. You don't want to give a large percentage of your company to a dev shop or consulting firm. There are predatory accelerators and dev shops and consultants who will say, hey, we'll give you 10K, plus we'll build your app, which will cost $500,000. It'll take us 6 months, and we value your company at $2 million. So we now own, for the 100K, we own 5%. And for the 500K, we own another 25%. Now they own 30% of your company. And now you're going into an accelerator. They get 7%. Now 37% is owned by investors. And then a seed round happens. You dilute 20%. Oh my God, you're way behind the numbers I just stated. So We see this all the time. It can be fixed. It's just painful. So one of the things that happens all the time is a company that's done too much fundraising will get to a new fundraising round, and the investor will say, listen, I will give you $10 million for your Series A for 25% of the company, but the founders are only at 30%. I want to see them at 50%. So therefore, I want to do a founder refresh. And that's not coming out of my 25%. That's coming out of everybody else's. And so boom, now all your previous investors get diluted. They all feel terrible about it. How do you mitigate against them feeling terrible about it? Well, if they can participate in the new round, well, then they can at least buy more shares and keep their percentage ownership up, aka pro rata. And another way to do it is to just be fair with them. Maybe put that additional founder grant at 5 years. Maybe the founders each get 2% a year for 5 years, 1% a year for 5 years. I've seen 5%, 1% each year for 5 years. Basically locks in the founders. If they've been toiling away for 3 or 4 years and they're fully vested, you might have to do that anyway. But this can create a lot of bad feelings. And sometimes a venture capital firm, I've seen this 3 or 4 times recently, a venture capital firm will say, to win a deal, we'll give the founders a 25% founder refresh, and we want these terms. And the founder says, oh, this is the best deal we could find. I couldn't get anybody else over the finish line. And now you got this inside dealing. Is it illegal? Is it unethical? Was that the best deal? Well, the fact that we have to sit here and debate it is what creates all the bad feelings. Because I've had a situation recently, I won't say what company, I'll make this a little bit mysterious by blending the numbers here. But I had a company that couldn't raise a round except with this one predatory jerk CEO, a VC, who wanted to give them a whole bunch of equity. I got the internal folks to make another offer, and they didn't take the internal offer. They still wanted to go with that one. So then it was like, okay, the founder is really just looking out for themselves, and we don't need to be involved with this company anymore. We're going to basically, not participate as much as we would because the founders kind of screwed us, right? And that's the bad feelings that you don't want to have with your investors. So you have to be very careful about this stuff. It is a little dicey. Communicating well and being reasonable is the way to avoid this. But sometimes you get predatory VCs, jerk VCs who will just put in these like take it or leave it offers. Then it's up to the existing investors to give an offer that is reasonable to the founder. And, then the founder has to want to take it. And none of this is easy because the founder could quit. The VC could pull its term sheet. The existing investors can sue. All kinds of bad things that happen. And that's actually kind of the great part about equity structures is because everybody's tied to that share price and the number of shares they have, this kind of debate can happen. If you listen to This Week in Startups often, you've heard me talk about Odoo's suite of business apps a lot. Well, they're going to give you your first app free forever and then $1,000 off your implementation pack at odoo.com/twist, odoo.com/twist. And here's why Odoo is so great for startups. Well, their suite of business apps can help you run your entire company from just one platform. They're going to streamline all your workflows by bringing all your information together. This eliminates all the annoying repetitive tasks like entering data across multiple platforms. Plus, if you only need 2 or 3 apps right now, that's okay. Use those 2 or 3 apps to optimize your workflow, and that's all you'll pay for. Odoo is not going to charge you for apps you don't use. Of course they wouldn't do that. So Odoo offers 30 main apps and over 16,000 apps from their open source community. The apps they have with bookkeeping, sales, CRM, website builders, and more. Again, your first app is free forever, and Odoo is offering $1,000 credit on your first implementation pack. Go to odoo.com/twist for $1,000 off. That's odoo.com/twist.